Ladies and gentlemen, Greg McCloskey from ForexLive.com. I'm going to take a technical look at the price of gold as we head into the weekend. Still lots of tensions coming out of the Mid-East, which is keeping the price elevated. Let's talk about the technicals. This is what the price of gold looks like on the hourly chart, and you can see the run to the upside here. And that run to the upside was able to, way back here at the beginning of the month, well, around the 9th or 10th of the month, was able to get above the 100 and 200-hour moving averages. And we had one final test of the 200-hour moving average here, and then it started to run. And each of the dips down through here, well, there's really no dips at all. But you can see that this dip right here was the closest that we got to the 100-hour moving average, and that wasn't even that close. And the rest of the time, the price has been running to the upside, including today's trading, where the price currently up around $15.56 or 0.79% after reaching a high of just short of the $2,000 level at $1,997.16. So that's the hourly chart here on the for the price of gold. On the daily chart, if we look at this price action, if we go back to Fridays and Mondays trade, the price high on Friday last week came up to test its 200-day moving average, and we did the same on Monday. That was coming into the weekend last week with all the tensions in the Middle East. So I'm not surprised that we saw that big, huge move on Friday that took the price up to those moving averages. However, sellers leaned against the level. Why? Because risk could be defined and limited against the level. And as long as the price was to remain below, maybe the price could rotate back to the downside. Getting below the 38.2% retracement would have been a clue that the sellers are sort of winning, or at least they have some confidence that the 200-day moving average held, and they have a potential for a move perhaps down toward this low prices through here around that 1886 level. But that was not to be. The 38.2 could not be broken on the downside on Tuesdays or on Monday's trade. On Tuesday, the price remained below the 200-day moving average, but on Wednesday we saw the surge to the upside. You can see it right here, breaking above the 200-day moving average as concerns about the Gaza Strip of going on in Israel started to intensify, and we've seen the price move sharply higher 3 consecutive days in a row. The move to the upside, as I mentioned, got close to the natural resistance level at the 2,000 level, and perhaps that is what traders are leaning against now to take profit into the weekend. But don't be surprised if we do see continued momentum into the close. Why? Because of that weekend risk when the markets are closed could force the buyers to the upside. So be aware, be prepared. But on the buyers remain in control in the price of gold, getting above the 1988 level and above the 2000 level is the next target. Then we'll start to look toward the 2047 level and perhaps even the high price for the year, going back to the price of in April, May at $2,081. It's all in play. What would hurt the bias? Well, if we go back to the hourly chart, getting below the 100-hour moving average would certainly be of significance, but that's all the way down at $1,946. The good news is that that moving average is moving higher over time. So if we get some consolidation or some news that forces the price down, and it is just $40 away, we could head down to and through that level. We could see the buyers turn to sellers. It would probably take a fundamental story, however, for that to happen. So there you have it, a technical look at gold. My name is Greg McCloskey. Good fortune with your trading. Bye-bye now.